And let's get in a fundamental view, as we always do, post-open. Dipen Sheth, who's head institutional research at HDFC Securities, joins in with his perspective. Dipen, it's great to have you on the show. Thanks very much for taking out the time. The sell-off in OMCs, is this the market's way of telling that, conveying actually to all the stakeholders and all the authorities involved that we're not very convinced about how you would manage rising oil prices, and we think it's a problem?
Right, I couldn't agree more. While most brokers, including ourselves, have value buys, if I may say so, on the OMCs, the sensitivity that these businesses have to government policy and this entire, this illusion of saying that we can price our products the way we really should in line with business or economic sense is not right now washing with investor sentiment. And investors are telling them that, look, we don't care what you're saying. We have a feeling that you won't be allowed to raise prices because that will lead to backlashes of both inflation as well as political backlash for the government at a time when 4 elections are coming up, 4 large state elections, and not to mention the 2019 big whammy. So OMCs were and still are businesses that are terribly, terribly vulnerable to government decisions, and hence should command lower valuations than what people think. Headline PE numbers won't make sense because if you run into earnings downgrades or ROCE downgrades, in case receivables also mount up, in case their balance sheets expand, I think they should command lower valuations. We've been proved wrong here. Let's accept it humbly.
Okay, Dipen, what about IT? Morning firstly, and what is it that you've made of TCS's numbers? There's no denying that it's a strong reportage, has always been the leader in the pack, continues to deliver good numbers, the management commentary is strong, but how much more can you scale up in the stock price given the kind of peak valuations that it's already sitting at? Or do you think we're in that kind of market wherein there are very few takers for a few stocks and everyone's willing to pay that kind of premium for quality, and therefore TCS should be no exception and the stock will have further upside as the brokerages seem to be indicating today?
So this is a little difficult to call. The business is a fabulous business. TCS is now, I think, a quarterly run rate of close to $5 billion, and this will only grow by another 8-9% over this year. It's admirable. It's all the more admirable because they've upped digital as a percentage of their revenues on a very large base now to significant levels, and they've arrested the fall in the rest of the business. Everything's going right for them. There are 2 flags that I would like to hold out on TCS, and if it can get over these hurdles, then the stock is certainly due for a re-rating. Remember, brokers like us are rating TCS a tad lower in terms of valuation multiple for FY20, let's say, compared to even a mid-cap like Mindtree, where we are thumping the table and saying it should trade for 20x because we can see 30% plus profit CAGR at the latter. Having said that, TCS has a challenge on its hands in terms of building out or reviving growth at its large BFSI slice in North America. So that is one bit that we should watch very closely. It doesn't take away anything from the greatness of the company, it doesn't take away anything from the fact that they've done a fabulous job so far. What also adds to the value is, of course, their stated intent on paying out large dollops of cash. 80 to 100% of free cash flows will be distributed to shareholders, whether as dividends or buybacks and what have you. So at 2,800 rupees, TCS was a value stock. At 3,100 and thereabouts, I don't know whether you can call it a growth stock, but if it gets hold, or if it sets right the BFSI slice in North America, if it gets headline growth anywhere close to double digit for some time at least, I think the stock could be due for a re-rating. But right now, valuations at 19.5x look adequate to me, quite frankly.
Right. Okay. Going on to the next story, how can we not ask you about Fortis? And I'm sure you have a lot more to say than we have to ask.
Not really. We don't have them under coverage, and we think there's a lot of corporate action happening there. So we'd like to stay clear there. I think you've guessed me wrong here, and I really don't have a comment to make.
Not specifically, Dipen. How do you see such takeover battles really ending up? At one, and I I don't want you to comment on, whether you see value in the business or not, or, whether you are, whether it's under your coverage as a buy or not. But I just want you to give us your view on how the saga is played out, because at one point in time, Fortis was seen as a liability. Nobody wanted to touch this business with a barge pole. And now it seems like one person has thrown in the towel, and suddenly everybody sees the kind of scope and scale the business can reach if efficient turnaround, if an efficient turnaround is brought by. So how do you look at the end game of a takeover battle like this?
So my broader take on the story is that hospital franchises or healthcare franchises, healthcare services franchises are very difficult to build out. Obviously, there's a lot of regulatory and what should I say, brand building challenge involved in setting up these businesses. They consume large dollops of capital and they take a lot of time to build out. So if somebody has already done that and there is a corporate level problem, but the business itself holds potential, then I think it makes sense for somebody with deep pockets and a long-term intent in the business to take over the assets. The other thing that makes it interesting is that the penetration opportunity here and the broader opportunity that faces an investor is magnificent in this country, and the long-term potential for running a healthcare business or a hospitals business in India, a well-managed hospitals business, a well-operating and a business that has got deep brand franchise is enormous. So I think that is what is tempting some of the people who are throwing in the gauntlet to take up this business. It's a little ironic that this change should happen because of what people see as governance failures on the part of the promoters, but that happens, and maybe I think what will happen to the Fortis healthcare brand here on is that it will probably find very strong and capable hands which will probably take it into the future in a much more sensible and should I say productive and profitable way for shareholders.
Under your coverage, if you see value in the broader healthcare theme in specific in Fortis, and do you think whoever wins the deal, given your own opinion of whether they're the right suitors or not, would you bring it under coverage? Is that pretty much on the radar?
So we've had coverage on pharma, obviously, which doesn't mean that we don't track some of the hospital companies. But the challenge there is that the challenge in the hospital companies is that right now, because they are in, so even after all these years, it's still a very, very underpenetrated industry, and we really don't have very large businesses there. So there it is. I would still call it a sunrise sector. And it's going to be a sunrise sector for possibly another decade, after which it'll come to fruition. So as classic ROC or free cash flow oriented investors, we think there are challenges, but there is certainly an opportunity to build a durable and growing business over the next few decades here. So we'll see how it happens. I would really not hazard a guess on whether we'd like to cover them or the sector in general.
We leave Fortis aside, Dipen, but